Okay, let's go ahead and get started here. Everybody should be able to hear me okay and see a slide up on the screen right now. It says Speedline Trend Trading and Stock Index Futures. Everybody see that and hear me okay? Okay, super. All right, this one's going to be done a little bit differently than we normally do it. First of all, I want to go ahead and start out by reminding everybody, that as with anything with these presentations, these are not a recommendation for you to go and buy or sell an instrument, financial instrument. You guys do get the opportunity to watch me do my trades here, but you guys always have to go ahead and consult your registered financial representative, as you know. We've talked about that, so pause this screen and look at it, whenever you need to. Keep that in mind. And so, like I said, read this thoroughly here and always consult your registered financial representative in your risk trading plan before ever investing or trading in any instrument. Okay? I don't want to have to read this verbatim. I'd like for you to go ahead and take time to pause it and read it. And then, in light of past experience here, the first time I just went in, of course, removed a person from the room who shared this information outside. Next time I'll pursue it even more forcefully. So please go ahead and don't share my video files, output, slide presentations, and everything with anybody else. If you feel you have a legitimate reason to do so, please go ahead and contact me, for permission to do so. So keep that in mind. Again, pause this and read it if you need to. I don't want to have to read this, verbatim, but the information is certainly there and posted. Okay, what we're going to do here is we're going to talk about the speed line setups. There's going to be variations of that, and we're going to talk about the entries, stops, exits, and again, those variations of that. And certainly I've got a lot of slides to go ahead and show with this today. And so, but I'll be looking out for questions as we go through the process, and I'll try to answer those questions. If I know the answer is coming up shortly, then I will go ahead and just let you know so that we can wait till we get to the actual section for that. Okay. And with that being said, I'm going to do this, like I said, a little bit differently today. Normally what I just do is go ahead and I do a presentation where I have the text. Then the very next slide, I go ahead and I have like the example. And then we move on to the next slide, read the text, and then I have an example. What I'm going to do today is I'm going to actually go through the presentation, and then we're going to go through like 50 different charts manually. Okay. Wyling, it's probably best that you take notes. But Wyling, you're also in the room here, and you're going to be for months, so you're going to go ahead and actually get this information on an ongoing basis live. Just like you watched me trade yesterday, and you watched me trade last Friday. With using these actual setups here, you're going to go ahead and see this ongoing. So, take notes, but you're going to see it every day, being here as a, multi-month member of the room. So the concept of this, what I'm calling the conventional speed line setup, because you're going to see variations of this, okay? But the conventional speed line setup here for this trend trade is a 3-bar setup. Excuse me. Again, apologize about the voice there. We talked quite a bit yesterday, and I'm paying for that today. So it basically consists of 3 bars, speed lines, and a trend. Bar number 1, we're looking for rising volume and trending in the direction of the speed lines. Okay. Bar number 2, we're looking for additional rising volume over bar number 1 and a close beyond number 2. Kind of sounds familiar, doesn't it? It's almost like a Hoffman 2-bar break of a supported resistance level, except that it's not. Okay. And bar 3 is going to be the pullback to a speed line in the direction of the trend you're trading, but the close is going to be on lighter volume, okay, than bar number 2. So it's very much like it's almost like a Hoffman 3-bar setup, but it's not. Okay, this is the conventional one. There's going to be variations of this we're going to show as well. The 20-period moving average, the RSI, and the MACD, excuse me, should all be trending in the direction of that proposed trade. So the speed lines really are ideally resuming a trend in the direction of the 20-period moving average. What I'll do, let me just go ahead, and I do want to take a moment to pop up an example just to give you a quick feel, visualization. Like I said, we're not going to go ahead and pop up too many examples right now. I just want to go ahead and give you a little bit of a feel for what we're kind of talking about. Okay, so here you see, and we're going to go through about 50 of these one by one and look at them across the time frames. I'm just trying to give you a quick little visualization. So we're looking here, and this was actually an early morning trade, setup here. And so I intentionally want to point out, because these things can work in early morning. So those of you that are in Singapore, Thailand, Australia, and that, where many of us are sleeping in the United States, you have the benefit of still looking for these. Can anybody see the chart on the screen there? I see Rick says that he's not seeing it. Okay, so everybody else but Rick is seeing it. All right, Rick, you're going to have to take a look at your system. Well, that's very strange. Let's go ahead and let me just do this. I'll try a little bit different setting. Okay. Jin Young, can you see it now? Just want to make sure everybody's on board there. My trading desktop. Okay, right. Jin Young, can you see me right now moving, making a yellow circle? Yeah, okay, that's what you should be seeing. These are snapshots of my system here, of my charts, because that's what I want you guys to be able to see. That's why I'm doing it a little bit differently. I hope everybody understands that. Rather than give you a little picture on a PowerPoint presentation, I wanted you guys to be able to, like we normally do, I wanted to try to strengthen the learning process and show you what things look like as they're going ahead and on the different time frames. Okay, does everybody understand that? I also included the daily chart because I made these very recent examples here so that you guys could go ahead and go back and look at them even more, and that we'll be able to talk about them here in the live trading room as we go forward. Okay, since every one of you here is a member of the live trading room, we can talk about these today thoroughly, and then we can go ahead and continue on with the education going forward. All right, so everybody can see this, so that's good. So what we're looking at here, what I want to show you was in pre-hours, you see we had 2 higher bars of volume, and then the 1 bar pullback, which pulled back to a speed line. And then it took 1 extra bar, but then it started to go ahead and move up. Okay, this is just, like I said, one brief example. I'll go ahead and pull up one more just to give an idea. Here's a downward example. You see the 2 bars, heavier volume, 1. So the difference is this is basically like a Hoffman 3-bar setup, except that it doesn't have to break a support or resistance level to be a valid trade. It can actually, it's really the trade without the break is what it is, as long as the speed lines go ahead and match it. So that's kind of the classic version of it. Okay. Like I said, we're going to look at about 50 examples, and we're going to look at them more thoroughly later. I just wanted to kind of go and give you a little something to visualize there before we get into many more issues there. So the 20, David, I would encourage you to take notes there. We also is this going to be, well, Paul, I will try to flip back and forth, but right now, with the live market, between here and the live market, if there's something you want me to look at on the live market, I will. But I've got a lot of information I need to get out to people. So if you see something you want me to look at, I'll go ahead and I'll do that for you. But I've got a lot of information to get out today so that we can focus on these things going forward with the trading. So let me know if you need help on a specific trade, if you want me to look at something technically for you. But I do got a hour's worth of stuff to cover here. So the thing is then that the 20MA, the RSI, and the MACD are trending in the direction of the proposed trade. The speed lines are ideally resuming a trend in the direction of the 20-period moving average. What's basically the strategy of this setup? The strategy focuses on trading with the trend. The 2-bar trend with the volume combined with the speed lines, RSI, and MACD strengthen the probabilities of the continuation of the trade. If we've got a couple bars, it's just from like a 2-bar break perspective, I want to see that there's some power and some significance behind it. And the volume goes ahead and helps that as well. But then if we have the speed lines, we have the RSI, we have the MACDs, all those things that I have started to brief you on the last couple weeks, really try to get you to focus on those things. We're all in preparation for what we're doing here. And of course, you saw me use that here in the last couple of days where you're actually starting to watch me do those trades, okay? And the conventional strategy here, the one that I showed you on the previous page, allows for a pause to refresh. Now that's going to be a variation from some of the other opportunities because not every one of them is going to require a pause to refresh. The conventional strategy that I shared on the previous page here, this goes ahead and does look for a pullback, okay, much more like the Hoffman 3-bar setup through support resistance. Okay, so that's what this also allows for, is the pause to refresh, excuse me, and a reduction of the chance of a stop-out pullback before the trend resumes by giving it a little bit of a chance to already pull back before you enter the trade. So you got bar number 1, you got bar number 2. If you take the trade at the close of bar number 2 and it has a pullback, then you know, depending on the nature and the intensity, how far the speed lines are and the 20-period moving average, from this point, this may reach your maximum stop-out point before continuing on. But if you wait for a pullback, okay, and it meets the different requirements, then this distance may not go ahead and stop you out. So the more conservative way of entering this, from my perspective, is to wait for the pullback bar. Okay, it's certainly more ideal. But as you saw last Friday, the trade I took did not go ahead and wait for a pullback because there are going to be times where if you wait for the pullback, you're never going to see that pullback. Okay, now the no trade rules are slightly different than my typical no trade rules. Excuse me. You'll see here, for instance, it's usually not before 1 a.m. Eastern Time versus my typical 3 a.m. Eastern Time for like some of the other setups. Okay, and the reason for that is we've seen even here in the recent past that many of these setups go ahead and manifest themselves in early hours. We have the opportunity between 1 o'clock a.m. Eastern Time and 6 and 7 o'clock Eastern Time to see these trades. In fact, I just demonstrated one for you here as an example just a few minutes ago. That was between 5 and 6 a.m. Central Time, so 6 and 7 o'clock Eastern Time. All right, and that was just examples from the last couple of days. All right, so basically, people. That's why, and that's why I mentioned here before Wai Ling and Jin Young and all of you that Mark K, I believe, or Marcus. I'm sorry, Marcus J, and all of you that are over, in the Far East there, that it's the middle of the night for you right now, can take a look at these setups in U.S. markets in early hours. Now, the other thing is, for a more conservative trader, you also want to be mindful of the fact that the volume is not met on the initial bars. Okay, so remember bar number 1 and bar number 2. What you're looking for here is, let me get the drawing tool out there. Again, bar number 1, you want to be up or down, depending on the direction of your trade. In this case, we're looking for a long side trade. As I mentioned this morning in my opening comments, my bias is to the upside. Right now, we've had some significant buy pressure in the last couple of bars, so that's kind of playing out there. So we're talking about long side trades here, and we've got bar number 1, bar number 2, and so this should be on higher volume than the previous bar back in here. This should be even higher volume, and then this third bar should be a light volume pullback. For a more conservative trader that's looking for the more ideal setups, if the volume's not met on those initial bars, or the hourly trend is against the direction of your trade, you may not want to go ahead and take that trade. Obviously, you should always consult your registered financial representative in the first place to determine what trades you should take. But nonetheless, I want to go ahead and make sure you right off the bat you guys understand some of the no trade rules there. So if we see a long side trade here and the hourly is going down, okay, what is very possible to happen? In fact, I'm going to show you actual examples of that. Again, we're going to be looking at about 50 different examples as we go through this, and you're going to see when the hourly is not in agreement, it can really stymie the length that the trend is in place. Okay, Tom's asking if the volumes I'm speaking about are on the short-term chart, 5-minute chart. And Tom, the short answer is I'm going to be showing you examples. I'm going to be showing you examples of this working on a 5-minute, 15-minute, 30-minute, and hourly chart. So depending on the time frame you're looking to trade, because obviously like a 30-minute chart is going to yield less signals but more profit. If that's your focus, then you'll be looking at the 30-minute chart. However, like in the room here, I'm going to be typically focusing like moment to moment, minute to minute when we're doing our trades in here, Tom. I'll be focusing on those 5 and 15-minute charts. However, if we see the setups on the 30-minute charts, excuse me, that's going to go and be very notable because those are the kind of trades that could easily, go 3, 5, 6+ points when you're talking a half-hour chart. You're going to be looking at staying in a trade possibly 30 minutes, an hour, 90 minutes, okay? But you're going to go ahead and nonetheless be those will happen less. So moment to moment, Tom, I'm referring to the 5-minute, 15-minute charts, but we will be keeping our eyes open. That's why I'm specifically going to be showing you several examples on the 30-minute charts as well. Excuse me, I got a little bit of a frog in my throat there. But good question there, Paul. And Tom, sorry. Good trade, Paul. Good question, Tom. Okay. Let's talk about some additional variations of this because as we've all seen, for any of you that have been with me at any length of time now in the live trading room in the last several months, we've continued to remain adaptable and flexible to go ahead and survive the market conditions that have been before us the last several months. It's been very volatile trade. Many traders have fallen to the wayside this year. And yet we are going ahead and continue to plug away, and we don't have the traders leaving the business daily like many places do. So as part of that flexibility and that adaptability, we want to go and be mindful of variations, and these variations can be very important. You will certainly be seeing on my end me taking variations of the trade I showed you earlier. I will not be waiting personally, and I just want to make that clear, I will not be waiting just for those conventional setups to take place. Okay. Mel, not at this time, as we talked about previously. I'm still debating what to do with that. Okay. And so but Mel, you're with me here for several months, so this stuff is all going to go ahead and be repeated daily. This is one of my, just like you saw me trade this yesterday and Friday, you'll be seeing a lot of these. So the so what we what I was saying here was that we have to have variations of these trades, because if you wait for the picture perfect trade, you're going to trade far less. Okay, so I'm going to show you some of the variations that I will be capitalizing on. Okay, just so that you're aware of them, and of course, obviously, we'll discuss them as I'm taking them in the room here. In fact, like I said, I already took a couple variations, as you've seen this the last couple of days. Right here is one of them. You recall trading after the close of bar number 2. If you think back to that Friday trade, we actually had the setup earlier. If you guys recall, we had the setup earlier on that Friday trade, but because we were at resistance, I could not take that trade yet. For those of you that were here Friday, you recall what I'm talking about. We were at resistance, so I did not go ahead and take the trade early on. Instead, what I waited for was for a continuation and for it to break above the resistance, proved to me it wanted to get above there, and then I took the trade after the close of the second bar when the speed lines were in play. So for anybody that doesn't recall, go back, watch Friday's trade. You'll see what I'm talking about. Okay, play the video for yourself. You'll see what I'm referring to. So trading the setup, even if the first or second bars are lower. So much like the 2-bar breakout, what's called the Hoffman 2-bar, which is in a more aggressive trade, if you don't have the volume, because like I said, in the more volatile times right now, we're seeing a lot more peculiarities, shall we say, with the volume. Volume number 1 may be a lower volume than, let's say, the previous bar, but it's still moving in the direction. You got speed lines going up and the 20 going up, and hourly is looking good. But bar number 2 may end up being higher volume than bar number 1. Well, that's still a kind of setup that I personally will be taking. Okay, I just want to draw the distinctions between what I will be taking and what's more conservative. What's more conservative is to go ahead and have the 2 bars of higher volume over each other and then a 1-bar pullback. Okay, that's the more conventional version of this trade. But I will be looking at the trade even if the first or second bar volumes are lower. Okay, it doesn't mean I'll take the trade, but it means I'm going to be looking at it. I'm not just going to be waiting until just I have those 2 bars, higher price, higher volume, and then the 1-bar pullback. If you wait for those, you're not going to get as many of those. Okay, so the last thing is then trading without 2 consecutive higher highs or higher lows, and I'll talk to you about that as well, because there will be times where we get the speed lines that turn back up. I'm just using up, gang, because again, I thought that today was going to be what did I say? The theme today was you're long until you're wrong. Okay, and so far as we can see, the market's rallying here. So just going ahead and Paul, I don't know if you were here for my opening commentary earlier, but that's what I was sharing with people based on yesterday's close and everything else, and so far that's panning out. So the last one here is trading without 2 consecutive higher highs. What I was going to say was you may have everything else in place, but bar number 1 may be a pushback in the direction with the speed lines. Bar number 2 may be, let's say, more of a doji star. And so what you'll see is bar number 1, higher volume, and bar number 2, the volume dries up significantly. Okay, this is one, and I'm going to show examples of this as well. This is one, that many times it may open up, pull back a little bit to the speed lines or so, and then continue on. Or when you, in a strong market, you get no chance for a pullback. It just goes ahead and opens up this next bar and starts tearing. It's like, okay, bar number 1 goes up, bar number 2 goes nowhere, volume dries up, nobody's wanting to sell it, and they take it off. Okay, so those are 3 variations of this to be mindful of. And again, you're going to go ahead and see this as we are going through the examples, and then all of you here, obviously in the live trading room, so you're going to see these as we're looking at them live. So the entry techniques here, again, for the more conservative, after 2 or more bars in the direction of the trend, enter on the close after the first light volume pullback at or near speed lines. Okay, that's a more conservative, more conventional version of this trade. More normal is after 2 or more bars in the direction of the trend with volume, enter on the close of the second bar. Now that's the trade you actually saw me do last Friday, okay? Because once these trends get going, especially when we get here, after we break out of what we're looking at with this current market, we know it's been very whipsawy around my 94.15 level here at the last couple weeks. Once we make that decision, as we've talked about, do we work our way towards 10,300? Do we work our way back down and have a more significant rollover? Once those trends get going, just like in a regular trending session, if you wait for this setup here, you may miss it, and so that's something to be conscientious of. So that's why I, just like I did last Friday in that trade, took the trade after 2 bars in the direction. It didn't wait for the pullback bar. Okay. The last one here is aggressive, which is entering on the close of the second bar in the direction of the speed lines, even if volume is not rising bar over bar. Okay, so volume is is ideal. We're looking for that higher volume. Okay, and so when you're trying to identify, for those of you that are more conservative, we're looking for higher volume bar over bar as the price is going up, or same thing, if the price is going down, we're looking for higher volume as it's coming down, and then you look for a light volume pullback. Okay, that's that's what we're looking for there. So it's very similar in nature, and a lot of the tools and techniques I've shown you guys, even since last year, crooked fingers, the broken arrows, all of these different things are going to become important here. The fish hooks, broken arrows, same thing. The fish hooks and the crooked fingers, for instance, will become very important as part of the pattern setup. In fact, you recall the trade yesterday ended up going ahead and having a crooked finger in it. Okay, everybody remember that? I pointed out the crooked finger. It specifically became part of my trading methodology as I was in that trade. So these things are building upon themselves, and so you're going to see more of that as we go forward. Okay, scaling techniques. The scaling techniques here, and again, I'm doing this one a little bit differently. Normally I go ahead and I discuss the concept, and then I go through and look at an example, and then we move on. But in this case, I want to spend a lot of time looking at a whole lot of examples. So I'm going ahead and getting through the text first, and then we're going to look at all these examples together. Scaling techniques. When we have our entry bar, and again, there's going to be different opportunities for entry as we talked about. So whatever your entry bar was, okay, you're looking at that as being, this is just one concept. Obviously, I'm still using the 6 contracts. I haven't done a recent survey. I know I've got, some of you trading a few contracts. I know I've got some of you trading up to 20 and 30 contracts. So I'm just going ahead and going with the previous known average of 6, okay? So obviously if you use 3, this is something you might want to look at. If you use 6, you're all smart people in this room. You guys can see how it applies to you. And the whole concept of the scaling, of course, is strictly an individual decision between you and your financial representative as well. Do you scale in? Do you not scale in? And so what we're looking at here is with the scale in, you go ahead, the market comes up. Okay, and let's say this is the 20-period moving average right here, 20 MA. And let's say the speed lines are right through here, all right? That's the slow speed line, and the fast speed line is right there. And let's say the market's pullback. This is a pullback bar, and this is when you decided to enter on, okay? So this would be, the first entry point. would be, here. Or like I said, if you're being more aggressive, like you saw me being last Friday on that trade, then, it'd be here. Here's would be my entry. All right, scale in. So that's, entry number one. Scale in point number two, okay, or entry point number two, if you will, which would be the first scale in, would normally be at the first slow speed line for me, okay? Unless the speed line is so close to the 20, then I'll forego the speed line and just go to the 20. Because in some cases, the three of these things are going to be very close to each other, like within half a point or so, okay? So this is space dependent. We'll look at different examples of this on the charts, okay? So this would be, first scale in point, second entry point, first scale in point. This is a slow speed line here. Of course, this is the fast one. And then the last scale in point is the 20, okay? Very, 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 very rarely will you see me scale in past that 20-period moving average. In fact, about the only reason I can think of that would happen is if this 20-period moving average, let's say this is a 5-minute chart, and then the 20-period moving average on the hourly chart happen to be very close together in proximity. So if this happens to be at, like right now we're trading here at 1028, so if this happens to be at 1028, okay, and this next one on the hourly chart happens to be down here at, let's say, 1027 and a half or so, okay, especially if this happens to combine with one of my key support or resistance levels, and it's close enough on the hourly chart, then I may look at scaling in or just holding off on my scale in here at the 20 and just scale in down here at the hourly 20, okay? But typically, that's as far as it's going to go. It's not going to be, okay, this is going up, the market turns around from my entry point up here, goes down to here, and I'm still like scaling into this. Okay, you're not going to be seeing that thing. I can't think other than an hourly chart going in and being in the direction of this. As you've already seen the last couple of days, my intention is to keep the stops very tight on these trades, giving the chance for the winners to run and keeping the stops tight. And speaking of stop outs, first and foremost, again, you should always place those, with the parameters you and your registered financial representative set forth. I see that people want to go ahead and mimic my stops. Obviously, on this trade, I'll be keeping my stops pretty tight, but nonetheless, you really need to stop out where you feel comfortable. Okay, have that discussion internally with yourself how you're going to go ahead and do this. Typically, from my perspective, from my trading, as I've mentioned on these so far, or up to this point, I've mentioned this to you guys before, that as far as I'm concerned, if the trade moves against me and closes back beyond that 20-period moving average, that's indicative of a stop-out point. Why is that? Well, here's the fast speed line. Here's the slow speed line. Here's the 20-period moving average. Well, I've got this trade going up my way. Okay, appears to be then a new direction is formed. And let's say we get the pullback bar. All right. Well, what I'm expecting then after this pullback bar, okay, that's supposed to be a shaded bar here, is then a continuation, a resumption back in the direction of the trend. Okay. If it turns around and the market actually goes down here, now I've seen it where it does trade below the 20 and then it closes back up. In fact, sometimes those become the strongest trades, don't they? Richard, what kind of trade is that? When we see it, it turns around, it comes down, makes a lower low, comes back up. What do I call that? Or anybody who wants to answer there? That's right. It's a key reversal up back in the direction of the trend. So it's a trend continuation opportunity. So very good, Rick, as well, both of you. So the point is that coming down below, okay, this point, maybe down to a lower speed line or below 20, and then closing back up is a good thing. But to go ahead and have this bar come down and then close down, so now we have this thing all shaded in, that's breaking the spine of this trend. So that, from my perspective, is a stop-out point. That is not what we expected to have happen with this trade. You're looking for because then basically you're violating the fast speed line, the slow speed line, and the 20-period moving average. So 3 areas of strong support did not prove themselves out. Now, yes, after it comes down to here, is it possible that it turns around this next bar and shoots all the way back up? Well, yeah, it is possible that it goes ahead and does that. But so from my perspective, if we close back down below that 20-period moving average, that is not what I expected to have happen. Okay, so from my perspective, I'm looking for the exit. All right, so you go ahead and determine, of course, what you're looking for, but I'm going to go ahead and just keep it close to the vest here. All right, so those are my stop outs, and again, always consult your professional registered representative on that. As you guys know, I don't hold myself out to be a registered financial representative, or give you guys individual trading advice here. You guys get the benefit of seeing what I'm doing with my trading. And then as far as the exit techniques, okay, Paul. Well, like I said, long until we're wrong today. So as far as the exit techniques here, for a conservative, we're looking on exiting on the close of the next bar post-entry. So let's talk about that for a minute. Okay. So we've got, I'm just going to use the more conservative one, okay, for a moment as the example. Okay, so what you would be looking to do if you took this particular trade, this is a conservative setup to the 2-bar push, and let's say the volume was there, the volume was light here. If you're just looking to go ahead and be in and out of this market, so basically you're very afraid to be in this market, maybe this because the technique's new to you, more importantly because you don't feel comfortable or don't know how to raise your stops up in that. Now that's another issue. If there are people here that don't know how to move your stops and that kind of stuff, let me know. We'll do a separate training on just doing that, okay? So we'll go ahead and be happy to help you, because moving stops, in my opinion, is critical to the success of this trade. You're not going to just want to keep your stop at -4 ticks, -8 ticks, -12 ticks, whatever you use forever. And at some point, as this thing is making money, you're going to want to go ahead and move your stops up. That's at least how I'm going to be trading it. Certainly you do it the way you want to do it and what you and your registered financial representative set forth, but I'm going to be focusing on these here. But for a more conservative person, they may say, you know what, I loved it. I like the fact that it works. I saw the 1-bar pullback. I just decided to go ahead and exit at the end of this trade. I'm not used to this whole moving my stops up thing, so I just killed the trade at the end of the next bar. So whatever bar you enter on. Now, of course, if you're an aggressive, more aggressive trader on this, and I hate to use the word too much aggressive on this because it sounds like a negative connotation, but I guess we'll call it a variation of the technique, is going in, exiting, or entering on the close of this bar. If you have it written in your risk trading plan that you're going to exit on the close of the next bar, then what you may find yourself doing is going in and actually exiting on the pullback bar right before the big move goes ahead and happens. Okay, so keep that in mind as you're developing your risk trading plan on this strategy. You want to factor that in. I know there's a couple of you here that have been working on your risk trading plans, like Charlie. So Charlie, I'm speaking to you on this, for instance. Keep that in mind as you're developing your risk trading plan, that you want to go ahead and focus on, okay, conservative versus more aggressive, versus let's say hyper-aggressive entries, and then what's your exit strategy? Is your intent just to keep, let this thing run up and follow one of these two, or are you going to get out at the close of this next bar? So you're going to want to define that in your risk trading plan, okay? And let me just take a moment to look at Peter's question here. If you put your stop in below 20 and trades there, your stop is hit whether it turns back up or on the bar or not. If you see what, well, that's absolutely true, Peter. If you have your stop in place here, what I said was, I talked about the close of this bar. Historically, what I do is, as you guys know, I talk about emergency stops, and I keep my stop a little bit wider there because I have the discipline to make sure I get out of a trade. Unlike many junior traders who just keep moving the stop, moving the stop, moving the stop, say, oh, wow, no, now I'm down 5 points. Okay, well, it's got to stop here. I'm going to move it to 6 points. I'm going to move it to 8 points. It's got to stop. It's got to stop. I don't do that. Okay, it's a real junior trader mistake. What I'm typically looking to do then, Peter, is in this kind of situation, I do have my initial stop set to 8 ticks, but what I do then is I evaluate whether the close actually is going to come down here to this distance. What you're talking about is having your stop pre-placed, move it up there so that you're right below here. What I'm saying is if you do that, then you do risk exactly what you said, getting stopped out even if the thing turns around. What I'm saying is, let's say your stop is down here, the 20-period moving average is up here, it closes down below. Even if your stop is way down here, it doesn't matter. You're going ahead and exiting the trade. You're closing the position out on that trade. So I'm not saying go ahead and just blindly move a stop up right below the 20 here. I said that you're looking at it if the market closes below that. So what that means is you have two choices. You can put a fixed stop in there so it's already there before the market even ever comes down to this area, because you may say, because that's an individual thing, Peter, you may go in and say, you know what, if it even comes down to the 20 here, that wasn't even what I expected. I expected this next bar just to open and tear up, or I expected it to go no further than the speed line. So then you may say to yourself, okay, well, I want to go ahead and put my physical stop right below the 20. Okay, but if you do that, then you're not following the one strategy, which is fine, because everybody's got to go and look at this themselves. I'm showing what I'm doing, and then you can go ahead and formulate your plans based on your registered financial representative and your risk trading plan. Can't emphasize that enough. I always say it, but people need to actually listen and hear that. So what I'm saying is that we're going and moving the stop up, or we're just, even if the stop is down below, we're going ahead and canceling out of that trade and closing the position if it closes down below, even if your stop is down here. So that's a different strategy than going ahead and you just blindly moving your stop up down below, because as you pointed out, you will get stopped out if it turns around. It could be a perfectly good trade back to the upside. You could have a nice key reversal up on this trade, but you won't be in it because you'll have been stopped out. But, like I said, that's not necessarily a bad strategy. It's something people need to evaluate. Were you expecting it just to take off the next bar and it's all of a sudden going and taking a bigger dip than you thought? So it's to each their own, as far as their comfort level. Okay, on that trade, on that kind of trade. So just understand that, know that, and but I'm showing it the way I'm looking at it here, which is I have right now an initial stop set at 8 ticks. Okay, but if it closes below that 20-period moving average, even if it hasn't reached 8 ticks, I'm going to be looking at exiting that trade. I said the only variation of that would be if the hourly happens to be within half a point or so of that, close enough that I feel there's enough support for one more bounce to maybe scale out break even or something like that. Normally, though, for me, this is how I'm going to be looking at doing my exits. Not this way here, okay? So I should actually say not this way here. Tom, that's a question I've addressed actually in the past when I've shown this, leading up to this. And the short answer is you have to, the question is what is far above and what is far below, and would you still take that trade? For instance, as you know, and you've seen here, my usual comfort level is usually no more than 2 to 3 points away from like the 20-period moving average. If the speed lines are, so Tom's question is, if the speed lines are far above or below the 20-period moving average, would you take the trade? And as I've said all along in here, we have the situation where we've got the speed lines. These are, well, that's okay. We'll even do it this way. Where the fast speed line is up here, let's say at, right now we're trading at 1029, so let's just go with that, 1029. Okay, then let's say the slower speed line is at 1027, and the 20-period moving average is down here at, well, it's called 1026. That's a 3-point spread, Tom, down to my trade. I usually don't feel comfortable. Well, frankly, I lose my comfort level. It slides off dramatically after 2 to 3 points. So that's why I've always said that I'm going ahead and typically looking for tighter spreads. Ideally, 4 to 6 ticks or so is much more ideal. Where you got between the 20 and your entry price, but up to about 2. Okay, so going back to what I was saying here was the what I'm going to be focusing on for my exits, okay, in this trade is going to be right here and here. Okay, so let's review these. Moving the stop to break even or plus 1 tick as soon as the trade moves 2 to 3 ticks in my intended direction. Now you saw me do that last Friday, pre-holiday trade. The market moved 3/4 of a point in my direction. My target, because of the resistance level that we were in the middle of at that time, you recall we were almost in the middle of a resistance level, so my target was about 1 point away from the entry. So after it got up to 3 ticks there, I went ahead and I moved my stop up to plus 1 tick. Well, bottom line is, of course, right after that, it actually took me out of the trade for the entire profit of 4 ticks. Okay, but nonetheless, you got to see me, and so for those of you that don't remember that or didn't look at the video, go back, watch last Friday's. I believe it was Friday morning's video. We went ahead and did just that. Okay, and so looking at moving it up to plus 1 tick after you get some profit in there, so that you don't turn a winning trade into a loser. Now, a more aggressive strategy would be to go ahead and keep your stops wider and only move this up. And again, this is something you have to feel comfortable with in your risk trading plan. But a more aggressive version of this, and what some people here are more comfortable with, is keeping the stop wider and only move it up to, let's say, -2 or break-even level if maybe we've gotten through several minutes of trade. So basically, several minutes of trade have passed without any sort of result in your direction. So what you expect to have happen doesn't, is what it boils down to. Then maybe you'll look at tightening your stop. Or if you've begun scaling out at, let's say, plus 4 ticks or so, then you may want to go ahead and once you've got, let's say, that first point under your belt, you take a little bit off the table. So then you move the rest of it to -2 ticks, so that no matter what, you're going to go ahead then and take a loss or break even on the remaining after those first 4 ticks. So it gets up in your direction. This is pretty much what you guys saw me do back earlier this year with the live trade room when I was doing some of those trend trades. It moved up 4 ticks in my direction. I took some off the table, okay, and then it went ahead and moved up to 8 ticks. Well, after it moved up to 4 ticks, I think I moved up to around break even or plus 1 tick. Then it moved up to 8 ticks. I took a little bit more off the table, moved my stop up to plus 1 point, and then when it moved out to like 12 ticks, I exited the rest of the position. Okay, but so what I was using was kind of those increments. When I got to 8 ticks, I moved up to 4 ticks. Okay, when I got to 4 ticks, I moved up here, to break even plus 1 tick. There's certainly many different ways to go ahead and do it. Is there any one is there any particular way that's right versus wrong? Well, no, I don't think so. Completely, as long as your stops aren't too tight, you give your trade a chance to work. But at the same time, you don't want to turn a winner into a loser. And we can debate this all day, because what I find is most junior traders go ahead and they look at this with hindsight. And I've had some fun with this in the past. For those of you that were in the room earlier this year, you'll recall when I actually did this, I had group participation in my trade. I'm like, okay, gang, I'm up 4 ticks. Now what do you think I should do? Tim, you recall that? Okay, I'm up 8 ticks now. What should I do? And people were freaking out left and right. People, I should go back and pull that video up and show it. There were some people who are like, just dump it, just dump it. It was fun. And I'm like, no, because in the end, I'm going to manage the trade the way I want to. I'm like, no, I'm not going to dump it here. I'm going to tighten up my stop and keep letting it run. Take some off the table and let it run. So it was very interesting to see the different traders, with different personalities. And some people, of course, don't move your stops. Basically just let this thing run until it turns around and you eventually start losing money. Which I mean, at some point you got to exit. It was kind of weird to see the different personalities at work. It's like, well, when do you eventually want to take the profit on it? But everybody's got different opinions on this. Okay, so is there any right or wrong answer conclusively on it? Well, I'm not going to go ahead and say that there is, but I'm going to show you what I'm doing, and it's going to fall into these two categories here, where depending on the nature of the stops, like for instance, the -2 level. Well, if I feel that I've got real strong support at break even, then I may keep it looser. Like this. If I feel that my support is right near my trade, and so that if I start letting this go too far against that position, and I could turn a winner into a loser, then might stick more with this strategy. Either way, as we've seen these trades these last couple of days, live and in person here, they have the opportunity to make money. So even with a handful of contracts, there's some good money to go ahead and be made with them. Last Friday's trade, for instance, was just only 5 contracts for a point, so it's $250. Yesterday, as you saw, I went ahead and had the opportunity. I was up around $750 or $1,000, but I moved my stop up, and so it actually ended up taking me out of the trade for $250 versus the $1,000. So there you get to see, okay, both sides of the coin, both sides of the argument. But either way, I made money both times. Which, like I said, that's far better than many traders do. So you can see the pros and the cons of keeping things tight or going ahead and letting them a little looser. But generally, my strategy, as you'll see with this, will fall into this, not this. Okay, but that's me personally. Okay, if you do this, I'm certainly not going to hold it against anybody that does this. I'm just letting you, it's just more conservative. It's a little bit more advanced, and I recognize that for people that are newer to this, especially moving stops up or down. Of course, if we're talking about a push down. So some people don't feel comfortable moving those things around. Okay, or they're not familiar with their platform enough, and that's why I said we can demonstrate that here. Okay. All right. So with that said, I'm going to go ahead and what we're going to do for just a moment is it's actually we've been going for about an hour here, and I've learned from the past with these webinars that these, especially with me doing all this talking here, I need a quick break. I know many of you. Okay, Tim, very good. Why don't you go ahead and take a bio break there, and for everybody, why don't you use this as a quick opportunity, and we'll start back up here in about 5 minutes. Okay, gang, I have not begun discussing this one. I'm just going ahead and putting it up there, and we'll talk about it here in just a few minutes.